$180,000 Bitcoin by March 2026? Are they serious? That was my reaction when I first saw where the big money is betting. It's the middle of the holiday season, crypto markets are quiet, and yet some Bitcoin options traders are staking huge bets that the real party won't be under the Christmas tree, but a few months later. While most of us are wondering if we'll even get a Santa rally this year, these traders are loading up on call options, essentially bullish bets, targeting prices like $130,000 and even $180,000 for early 2026. Crazy, right? Why would anyone do that when Bitcoin is hovering around $90,000 and struggling to get a year-end boost? What do they know that the rest of the market doesn't? I was determined to find out. So I brewed a fresh cup of coffee. Okay, maybe it was eggnog. 'Tis the season. And dove into the data, options charts, volatility metrics, Fed announcements, you name it. And let me tell you, the story that unfolded is way more interesting than any cheesy holiday movie. It's a tale of big bets, big central bank moves, and possibly big rewards. By the end of this investigation, we'll see why traders are eyeing 2026 for Bitcoin's next explosive move, how the Federal Reserve's new policies might be lighting the fuse, and what history hints about what could happen next. But first, I have to address the elephant in the room. Am I predicting the future here? No. I'm analyzing and speculating just like these traders. Before we dive deeper, a quick disclaimer. I'm not a financial advisor, and nothing in this video is financial advice. This content is for educational and entertainment purposes only, and all opinions are my own. Always do your own research and make decisions based on your risk tolerance. Whew, glad that's out of the way. All right, back to the story. Grab a seat and maybe a snack, because we're about to unravel why 2026 could be Bitcoin's next big chapter. And trust me, it's more exciting than any gift wrap reveal. Ready? Let's jump in. Setting the stage. It's December 2025, and Bitcoin is sitting around the mid-$90,000 range. A solid price, sure, but not exactly the to-the-moon hype you might expect after a year of bullish news. In fact, after touching an intraday high of about $94,000 following a recent Federal Reserve announcement, Bitcoin actually slipped back to around $89,500. No Santa Claus rally to speak of. Instead, we got a bit of a Grinch. So what gives? Why aren't we blasting through $100,000 now? And why are some traders instead looking to March 2026 for the fireworks? It turns out the answers lie in a potent mix of macroeconomics and market mechanics. Think of it like a 1-2 punch. First, the Federal Reserve, yes, the stodgy central bank with the power to make markets dance, has quietly changed its tune, and second, Bitcoin's own market is showing signs of volatility hibernation, for now, that often precede big moves. Let's break it down in plain English, and I promise to keep it conversational and maybe even a little fun along the way. Remember how the Grinch's heart grew 3 sizes? Well, the Fed's balance sheet might be about to do something similar. Just this week, the Federal Reserve cut interest rates by 0.25%. A move widely expected, sure. But the real kicker is what came next. They announced they'll start buying about $40 billion per month in treasury bills. In non-geek speak, that means injecting $40 billion of fresh liquidity into the financial system every month. That's like turning the monetary faucets back on, at least a little bit, after years of tightening. And while they're calling it a technical move to manage bank liquidity, we in crypto know that liquidity is like oxygen for rallies. More money sloshing around can find its way into risk assets like Bitcoin. Here's why this matters. Lower interest rates and Fed money printing, let's call it what it is, generally make investors more willing to take risks. Suddenly, holding cash is less attractive since it yields less, and borrowing is cheaper. So where does that money often go? Stocks, especially tech stocks, and increasingly, Bitcoin. In fact, Bitcoin often behaves like a high-octane tech stock in these scenarios. When money is cheap, folks pile into growth assets. Think back to 2020 and 2021. The Fed slashed rates to near zero and launched massive stimulus. Tech stocks went bonkers, and Bitcoin rocketed from under $5,000 during the March 2020 crash to over $60,000 within a year. Low rates and abundant liquidity were rocket fuel for both the NASDAQ and crypto back then. History doesn't repeat, but it often rhymes, as the saying goes. And historically, Bitcoin's biggest bull runs have coincided with easy money conditions. Research actually shows Bitcoin's price is highly correlated. Some studies say 60 to 95% correlated with the global money supply, on them too. In other words, it's not just about number go up on its own. When central banks flood the economy with cash, some of that cash invariably flows into Bitcoin and pumps it up. Conversely, when money gets tight, Bitcoin has struggled. Remember 2022, when the Fed hiked rates aggressively? Bitcoin had one of its roughest years, sliding from approximately $69,000 all-time highs down to the mid-teens. So the fact that the Fed has pivoted from tightening to easing, ending its quantitative tightening, no more draining liquidity, and now starting modest injections, is a huge deal. It's like the wind changing direction, now at Bitcoin's back instead of in its face. To put a number on it, the Fed's quantitative tightening drained over $2 trillion in liquidity from 2022 to 2025 as they shrank their balance sheet. That era is over. QT officially ended on December 1st, 2025. Now, with the $40 billion monthly bill purchases, we're tiptoeing back into easing. One analysis notes that if the Fed is now growing the money supply again, Bitcoin could react with a lag of a couple of months. Imagine pouring water into a dry sponge. It takes a moment to swell. Similarly, if the Fed's new liquidity is like water, the Bitcoin market might be the sponge that swells up come January or February 2026, as that liquidity works its way through the financial system. In fact, some analysts are already mapping this out. A historical relationship between M2 money supply and Bitcoin's price suggests Bitcoin could target levels like $170,000 if liquidity expansion continues. That's a bullish scenario. Even more conservative forecasts see $100,000 to $120,000 as achievable if the macro environment remains supportive. Now, those are just projections, not promises, but they align eerily well with where those mysterious options traders are placing their bets. All right, let's talk about those bets. In the options market, for those not familiar, options are contracts that let traders bet on future price movements. Calls are bullish bets, puts are bearish/hedging bets. We're seeing something fascinating. First, even in the short term, traders are tilting bullish. The most active options strike right now is the $100,000 call expiring December 26th, 2025, basically a bet that Bitcoin could retest six figures by year-end. There are over 18,360 call contracts open at that strike, versus only 2,540 puts, bearish contracts. That's an enormous skew towards calls at $100,000, implying many traders positioned for a year-end pop. But, and this is key, the way they're positioned suggests limited optimism near-term. Many of those contracts are part of strategies like long call condors and bull call spreads. If your eyes glazed over, don't worry. The gist is these are spread trades that cap upside. They're not outright Bitcoin will moon to infinity bets. They're more like Bitcoin will rise some, but not too much. It's like betting your team will win, but by less than a certain number of points. These traders see a bounce, but not an unbounded rally into New Year. In plain English, they're hopeful, but not that hopeful for 2025's final days. Now, here's where it gets spicy. While near-term bets are cautiously bullish, the heaviest concentration of bullish call options overall is not for December at all. It's for March 2026 at strikes of $130,000 and $180,000. Let that sink in. Traders are basically saying, if you're looking for the real Bitcoin breakout, circle March 2026 on your calendar. Those $130,000 to $180,000 call options have become remarkably popular, suggesting that's where a lot of smart money sees real potential. They're effectively targeting a scenario where Bitcoin rallies approximately 50% to 100% from current levels in about 3 to 4 quarters from now. High upside indeed. It's not just the strike prices, it's the overall positioning. Across the board, bullish conviction is being deferred to early 2026. One options research analyst, Sean Dawson, put it succinctly, bulls are levering up for an explosive Q1 with that massive buildup of calls at $130,000 and $180,000. They see the real opportunity in that time frame, not necessarily right this second. This aligns with the Fed narrative. If the Fed cut just happened in December and liquidity injections start now, the biggest effects might be felt after a few months, which is exactly Q1 2026. Another clue from the options world, the 25 delta skew. Now don't run away, cite, that's just a fancy way of measuring sentiment by comparing how expensive puts are versus calls. If the skew is deeply negative, it means puts, downside protection, are pricier. Traders are more fearful of drops. If it's positive, calls are pricier. Traders are greedy for gains. Right now, Bitcoin's 25 delta skew has improved from about -8% to -5% over the past 2 weeks. That's still negative, but less negative than before. Translation: traders are still buying downside insurance, so there's caution in the air, but not as frantically as they were before the Fed's announcements. there's been a slight shift toward optimism, or at least less pessimism, in the options pricing. Downside hedges remain in demand, but the fear is easing up a bit. This subtle skew shift is like the market mood ring changing color, still a bit anxious, negative skew, yet gradually more balanced. It tells us that despite the Fed's dovish pivot, many traders aren't throwing caution to the wind in the immediate term. They're hedging their bets, sometimes literally on the short horizon, but growing more bullish on the long horizon. Let's talk volatility, the heartbeat of any market. If price action is a soap opera, volatility is the plot twists. Lately, Bitcoin's volatility has been, well, uncharacteristically tame. Implied volatility, which is basically the market's forecast of how wacky price swings might get, has been grinding down. One index, Deribit's BTC DVOL, fell from around 68% to about 49% in recent months. In fact, Bitcoin's volatility has gotten so low that, get this, Nvidia's stock, yes, the chip company, became more volatile than Bitcoin for a while. When a top tech stock known for its wild swings is outpacing Bitcoin's volatility, you know something strange is afoot. It's like finding out your straight-laced accountant buddy is partying harder than the rock guitarist. Role reversal. For Bitcoin, approximately 50% implied vol is quiet, nearly the calm before the storm. Historically, periods of unusually low volatility for Bitcoin often precede big directional moves. It's as if the market is a spring that's been compressed tighter and tighter, and we're waiting to see which way it springs once released. Why is volatility so low right now? A few reasons. 1. Year-end slowness. With the holidays, many big traders are off on vacation, and a lot of institutions have closed their books for the year. As Adam Chu of the analytics firm Greeks Live noted, late December historically brings the weakest liquidity conditions in crypto, with subdued market activity limiting any sustained rally. Fewer active traders means fewer dramatic price swings. It's hard to have a roller coaster when half the riders are at home with family. 2. Macro uncertainty had been declining. The Fed's move was anticipated. Big news events are out of the way, so there's a lull in catalysts. And 3. People are in wait-and-see mode. Implied volatility measures expectations, and right now, many expect Bitcoin to stay range-bound in the very short term. Think of it like the quiet intermission in a play. The audience is hushed, munching popcorn, anticipating the next act. This volatility compression is actually reflected in those options strategies we mentioned. Traders setting up condors and spreads aren't just capping their upside. They're also betting on a more controlled price path rather than a sudden moonshot before year-end. It's a very different vibe from, say, early 2021 when volatility was off the charts and everyone was buying naked calls like there was no tomorrow. Now it's more measured. We'll take a moderate rally, thank you very much. But here's the thing. Low volatility regimes don't last forever. In fact, when volatility is unusually low, it often means a big move is brewing. We just don't know which direction. Given the bullish tilt and positioning, many are betting that move will be upward. And the Fed's new easy money stance provides a compelling narrative for why it would be upward. So, why are traders dismissing the short-term softness, the lack of a Santa rally, the holiday doldrums, and focusing on 2026 instead? Because they see the larger forces at play. Short-term, there are headwinds, poor liquidity until the new year, people selling some holdings for year-end tax considerations, maybe a bit of market fatigue after a strong run earlier in 2025. Bitcoin did, after all, rally a lot this year. We even saw that right after the Fed cut, Bitcoin jumped on the news to $94,000, then promptly fell back to the high 80s thousands, almost as if the market said, cool, but we're not ready to run yet. One crypto quant firm estimated that any relief rally is probably capped around $99,000 in the immediate term, essentially just shy of that psychological $100,000 level. It's like the market hit the snooze button on the breakout, saying, let's save it for later. However, come January, all those headwinds could turn into tailwinds. Liquidity improves as traders come back from holiday, and that Fed T-bill buying starts injecting cash. New Year fund flows can begin. Some investors allocate anew in January. And importantly, the narrative might shift from no Santa rally to a New Year, new rally. Traders positioning now for March 2026 are effectively betting that by then, all the pieces will have fallen into place. The Fed's rate cuts will have had time to ripple through the economy. Interest rates will be meaningfully lower, making stocks and crypto relatively more attractive. And that $40 billion per month liquidity will have bloated some bank accounts and portfolios, some of which could end up in Bitcoin, directly or indirectly. They're also likely considering Bitcoin-specific cycles. 2024 was a halving year. Bitcoin's mining rewards got cut in half in April 2024. Historically, the year after a halving, which is 2025 into 2026, is when Bitcoin often goes ballistic. We saw that pattern in 2013, 2017, and 2021. Now, 2025 has indeed been a strong year. But if history rhymes, the true euphoric top might not come until somewhere in 2026. These traders might be effectively timing that, saying, the big move is still ahead of us. Add the Fed's newfound friendliness, and you have a potent cocktail. The scarcity-driven cycle, post-halving supply squeeze, plus the liquidity-driven cycle, Fed easing, aligning. If you're a macro-focused crypto trader, that's about as good as it gets. Hence the conviction in those high strike calls. Let's add one more ingredient: institutional confidence. It's not just options traders sniffing something in the air. Institutions are making moves that show long-term bullishness. Consider MicroStrategy, the company famous for hoarding Bitcoin. On December 8th, 2025, literally just days ago, they announced they bought 10,624 more BTC, a nearly $963 million purchase at an average price around $90,600 per coin. Talk about putting your money where your mouth is. Michael Saylor's firm now holds over 660,000 BTC, and their average cost is approximately $74,000, meaning they're sitting on profit but still buying at $90,000. Why? Because they likely believe $90,000 is far from the top, that it's an attractive long-term value level. MicroStrategy's huge bet effectively shored up $90,000 as a key support, at least psychologically. If the world's biggest corporate BTC holder thinks current prices are a bargain, other big players take note. It's a confidence signal to the market, and they're not alone. Other institutions have been quietly accumulating or investing in infrastructure. We even saw Vanguard open up Bitcoin ETF access to millions of clients in December 2025, and crypto custodians reporting record inflows. All this to say, the big money is positioning for further upside, not scrambling for the exits. So when options traders look at March 2026 calls, they're also likely thinking, we're not the only ones bullish on Bitcoin's future. The giants are too. Short-term price dips or a lack of a Christmas pump don't faze them, because the real payday, if they're right, comes later. Now, none of this guarantees that Bitcoin will indeed be six figures plus by March 2026. Let's be clear, these traders could be wrong. Unexpected things happen. Maybe inflation flares up again and the Fed reverses course back to tightening. Yikes. Maybe a geopolitical event rattles markets. Or maybe simply the rally takes longer and those options expire before the glory. There's always risk. Options, especially far out of the money calls like $180,000 strikes, can expire worthless if the timing or magnitude is off. These are high upside but still speculative bets. However, the fact that so many traders are making them, and that the open interest is so large, tells us something about the collective market psychology, optimism with a dose of patience. It's like everyone's looking at each other and saying, this party's gonna be lit, just not tonight. Let's chill now and not spoil the fun. The real celebration is a couple of chapters ahead. Picture this. It's March 2026. The winter snow, or Dubai sand if you're like me, has given way to spring. The Federal Reserve has perhaps cut interest rates a bit more by now, or at least firmly signaled that low rates are here to stay for a while. Those monthly $40 billion liquidity injections have quietly continued, pumping nearly $500 billion into the financial veins over the past year. Global markets are awash in cash looking for returns. Tech stocks are flying high. The Apples and Teslas of the world are hitting new peaks as borrowing is cheap and investors are euphoric. And Bitcoin? Bitcoin is no longer sleeping. Imagine the headlines. Bitcoin blasts past $130,000. That's a very real scenario being bet on. All that compressed volatility we talked about could be unleashed. The coiled spring jumps and Bitcoin's price starts moving fast, like really fast. Suddenly, those call options we discussed, the ones at $130,000, $150,000, $180,000 are in play. Some are even in the money, meaning Bitcoin's trading above the strike. Traders who bought those for cheap are now sitting on massive gains. Their lottery tickets are paying out. The narrative in the market flips. Instead of no Santa rally, everyone is talking about a full-on 2026 bull rally. CNBC is running pieces on Bitcoin's resurgence. Your distant relatives are asking if it's too late to buy now. And Twitter, or whatever it's called in 2026, is filled with rocket emojis again. It's a bit euphoric, maybe even bubbly, but that's how these cycles go. Now, am I saying this will happen? Not definitively. I'm painting a picture of what could happen based on the convergence of factors we've identified. The Fed's dovish turn, increased liquidity, historically low volatility poised to uptick, and traders already positioning for such an outcome. We've seen similar climactic runs before. After the Fed aggressively eased in 2020, Bitcoin didn't just rise gradually, it went parabolic in late 2020 into 2021. After the 2016 halving, Bitcoin took until 2017 to go truly exponential. In those cases, once key levels were breached, things accelerated. $20,000 to $40,000 in a matter of weeks in early 2021, for example. In our imagined spring 2026 scenario, crossing $100,000 decisively could act as a psychological trigger that opens the floodgates of FOMO, fear of missing out. And if a flood of new buyers meets the relatively fixed supply of Bitcoin, remember, post-halving, new BTC supply is low, prices can overshoot dramatically. The traders targeting $130,000 to $180,000 strikes are essentially positioning for being on the right side of that mania if it hits. They want to be holding those golden tickets before the rocket launches. It's the equivalent of buying festival tickets at face value and selling them when the show is sold out and everyone's clamoring to get in, except magnified by leverage and market momentum. One more thought for our climax scenario. If Bitcoin does rip higher, consider what it means for those who doubt it. All the people who said at $90,000, it's overextended, it won't go much higher, might rush back in when they see $120,000, $150,000. Human nature. That could drive it even further, at least for a time. This is how you sometimes overshoot even those lofty option strike prices. Could Bitcoin hit $200,000 plus in a blow-off top? Not impossible if the stars align and mania kicks in. But I'm getting ahead of myself. The key point is the groundwork for a potential explosive rally is being laid now. In story terms, we're at the part where our protagonist, Bitcoin, is training and gathering allies, Fed liquidity, institutional investors, bullish traders, for the big battle or big performance. The climax, potentially a roaring bull move in 2026, is being foreshadowed by all these subtle hints and side plots we've covered. It hasn't happened yet, but the stage lights are set, and the audience, market participants, are on the edge of their seats, popcorn in hand, waiting for the show. Will Bitcoin deliver the grand finale everyone's hoping for? The options traders seem to think so, and they've put their money on it. If they're right, the next few months could be a wild ride to remember. So where does this all leave us? In a nutshell, Bitcoin options traders are betting on the future, specifically a future where Bitcoin soars in early 2026. And their reasons aren't just wild guesses, but rooted in the shifting macro landscape and crypto's own historical rhythms. They see a perfect storm forming. The Fed has flipped the script from tight to loose, cutting rates and quietly feeding liquidity into the system, which usually bodes well for risk assets. Bitcoin's volatility is uncharacteristically low, like the market is holding its breath, which often precedes a big exhale or explosion of action. The typical late-year rally might be missing in action, but that doesn't bother these traders. They're looking past the holiday lull. They've essentially circled Q1 2026 on their calendars and written Bitcoin boom in red ink. We've also drawn parallels to the past. Lower interest rates and expanding liquidity have historically aligned with some of Bitcoin's most dramatic climbs, 2020 to 2021 being a prime example when an avalanche of Fed stimulus coincided with a crypto market frenzy. And critically, 2026 isn't just any year. It's the year after a Bitcoin halving, and now potentially the year of a Fed easing cycle. That combination is rare and exciting. It's like having the stars align, fewer new Bitcoins being created, inherently bullish supply-wise, and more dollars potentially chasing assets, bullish demand-wise. Supply down, demand up. You don't need an economics degree to know what that recipe usually cooks up. The data points we discussed reinforce that these aren't just vague hopes. The $100,000 strike call, open interest being so high, shows there's serious capital positioned for upside even in the short run. The heavy call positioning at $130,000 and $180,000 for March 2026. Signals where many see the real potential payoff. The 25 delta skew staying negative, albeit less so, reminds us that not everyone is blindly bullish. There's still hedging and caution, which is actually healthy and perhaps means there's plenty of dry powder if momentum truly shifts. And don't forget the external signs. The Fed's $40 billion per month liquidity boost is like a rising tide that can lift boats, and big players like MicroStrategy doubling down at approximately $90,000 suggests confidence that current prices are just a way station not the final destination. Of course, nothing is guaranteed. The traders making these bets could be early or outright wrong. Markets love to humble us. That's why risk management and those downside hedges exist. But personally, after sifting through all this, I find their thesis compelling. It's informed by logic and evidence, not just hopium. It's almost a contrarian play, in a sense. When many people are disappointed by a lackluster year-end, they're quietly positioning for the next big wave. It reminds me of a surfer paddling out right after a smaller wave fizzles, positioning for the next giant swell, while everyone else is lamenting that the last wave wasn't bigger. In short, Bitcoin options traders are aiming high for 2026 because the setup looks promising. A friendlier Fed, a market that's almost too calm, and a sense that the real action is still ahead. They're basically saying the 2025 story hasn't peaked, and the ending could be explosive. If they're right, 2026 could make past bull runs look modest. Whether they're early or spot on is anyone's guess, but it's worth paying attention. I'll be keeping an eye on the options market and the Fed as the new year unfolds. If you enjoyed this breakdown, hit like and subscribe for more first-person looks at what's happening under the surface in crypto. And tell me what you think. Are we seeing early signs of a Bitcoin surge? Or are these traders reaching? Drop your thoughts in the comments. If you want to dive deeper and chat with others in real time, join our free educational Discord. It's a relaxed spot to share insights, ask questions, and sharpen your investing skills. The invite link is in the description. And if you want structured learning, check out my crypto investing course at cheekyschool.com. Use the code YT50OFF for 50% off any course or membership. Thanks for hanging out today. I hope you got real value from this. Happy holidays, stay safe, and I'll see you in the next one. Keep your eyes on the charts and the bigger picture. We might be close to something big.